Hi, I'm Brooke Zachary with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizon Seasonal Rotation ETF, ticker symbol HAC, its weekly commentary, as a basis for this market update. So let's jump right in and take a look at the market action last week. Here you can see the S&P 500 had a gain of 1.2%. The Canadian stock market with the S&P TSX 60 index had a gain of 2%, outperforming the U.S. stock market. This is largely based upon strong cyclical performance, and also to the energy sector performed particularly well. If we take a look at the market action last week on a daily basis for the S&P 500, here you can see Monday, Tuesday, Wednesday, the market was down. The S&P 500 was down. Thursday, this bar right here, for most of the day, it was actually fairly flat, bouncing around. It was only in the last hour did we see this strong trend, this rally coming into the end of the day, as investors were anticipating a strong non-farm payroll, a jobs report to be released on Friday morning. Friday morning came, and the non-farm payrolls came out with the April's jobs at 266,000 jobs, substantially less than the expected almost 1 million jobs. And on top of that, the number for March was revised downwards. Nevertheless, the stock market rallied on Friday as investors surmised that the weak jobs report was so bad that must mean that the Federal Reserve is going to maintain its stimulus that much longer. If we take a look at what took place in the bond market last week, here's the U.S. 10-year Treasury yield. You can see on Monday it was down, Tuesday down, Wednesday down, Thursday down, Friday up. For the week, it was down. So what we saw was a rising stock market, and particularly the cyclical sectors, while the interest rates were falling. Usually what you see is if cyclicals are outperforming, you see the interest rates moving upward. And that's been the trend quite fairly recently. When the interest rates are moving up, cyclicals have been outperforming, and when they've been going down, when interest rates have been going down, cyclicals have been underperforming. That was not the case last week. If we take a look at the sectors of the U.S. stock market here's the S&P 500 red at 1.2%. The big standout was the energy sector here in teal, almost 9% now. There's a huge inventory oil draw last week, but nevertheless, that's a huge number. Materials, almost 6%. Industrials, 3.4%. Financials, 4.2%. Now that's a huge outperformance for the financial sector. Usually, what we've been seeing recently is interest rates are moving up, financials outperform. Interest rates are moving down, the financial sector underperforms the S&P 500. Not last week. We saw the financial sector outperform very solidly as interest rates were moving down. Consumer discretionary, communication services, technology, all underperforming the S&P 500. Look at this. I mean, it was the technology sector was negative last week, and investors have just thrown this sector to the side, despite some strong earnings as well. And the healthcare sector, we saw a little bit of a rebound, outperforming the S&P 500 after a weaker performance the previous week. If we take a look at some of the action that happened last week with some of the major trades for HAC last week, here we can see that HAC did decrease its broad market position in the market as the 6-month unfavorable period for the stock market started, which lasts from early May to late October. And HAC exited its industrial position, increased its healthcare sector position, went into the U.S. REITs. Now, U.S. REITs are a totally different beast compared to Canadian REITs, and U.S. REITs have actually been performing quite well recently. Also, HAC took on a position in the U.S. government bonds, as well as the U.S. dollar as well. If we take a look at what was happening in the markets last week, it was quite interesting to see the investors chase the cyclicals based upon the reflationary trade. After, over the last, let's say a month and a half or so, the cyclicals have really been sort of languishing around and actually, in some cases, underperforming the S&P 500. But last week, there's this shift back into the cyclical sectors. I'm not sure that that's going to continue for an extended period of time, and for three reasons. The first reason being U.S. government bonds. They're telling a different story. Last week, we saw interest rates going down, and we have seen interest rates. The peak in interest rates for the U.S. 10-year Treasury yield was on March 31st. And since then, we've seen interest rates moving down. And last week, we saw interest rates moving down, and we still saw the cyclicals outperform. And as I mentioned earlier, when there's a divergence of opinion between the bond market and the stock market, Doesn't always happen, but usually it's the bond market that's correct. So you have to respect that. So the bond market's saying we're not buying this trade into this big push back into the reflationary trade. We're just not buying it. So that's a little bit of a warning there. The second reason is that the cyclical sectors of the stock market typically finish their strong seasonal period around early May, which we're at right now. Yes, sure, absolutely. They can continue to perform well in May and June, but on average over the long term, they tend to fade around this time of the year. And the third reason is we just entered into the 6-month unfavorable period for the stock market. That doesn't mean the stock market is going to be negative or it's going to crash. It just means that at this time period, over the next 6 months, on average for most of this time period, the stock market tends to be a little bit weaker. It tends to be weaker compared to the last 6 months of the year and tends to have weaker, longer-term performance. Doesn't mean there's not sector opportunities. There's lots of sector opportunities for the market, and sometimes there's some broad market opportunities as well. But we've just entered into that period. So right now, despite this, investors chasing into the cyclical sectors of reflationary trade, which has just become hot again, we might not see it last that much longer, and this is the time for investors to be cautious. Thank you very much.